Good morning. This is Connor from 0DTE Traders here to present the week ahead for May 5th, 2025. This week, participants will turn their attention to the Federal Reserve as the committee is set to announce its third interest rate decision of the year on Wednesday. According to the CME FedWatch tool, there is strong consensus at 98.2% that the Fed will leave rates unchanged. Due to persistent inflation, both policymakers and Fed Chair Powell have indicated a willingness to pause rate adjustments while assessing incoming economic data. They are especially focused on signs of rising unemployment and an increased risk of recession before considering any rate cuts. Powell's upcoming press conference will be closely watched for commentary on these factors, as well as any potential developments related to tariffs. The first quarter earnings season will continue to roll on with key results expected from major companies such as Ford, Walt Disney, AMD, and Palantir. The SPX Gamma Index, which measures dealer gamma, currently stands at 114 million notional. This marks the first positive gamma print since February 25th, 2025. Key transitions are 56.35 flip, 56.50 gamma, so a bit of a zone. All strikes above positive, that is supportive for the market price. All strikes below negative, that is destabilizing for the market price. 5,500 is also maybe a secondary transition here, a break below. We will see that gamma index move strongly negative. Now, one print into positive gamma does not constitute a regime change. We must remain cautious for potential bull traps as dealer positioning often flips for a day or two before sharply reversing. The SPX 1-hour trend remains bullish with the 50-period moving average upsloping, although we're now getting a little extended. At this juncture, further upside is more likely to manifest as a positive drift rather than 1% up moves. And the potential for a snapback to this moving average 5,500 zone is increasing. Dropping the time frame to the 15-minute chart, the trend is up with the 50-period moving average upsloping but starting to flatten out, an indication of lost momentum. There's also an upsloping trend line, not super significant, but we are breaking below it here in the pre-market, set to open with a gap to the downside, 0.8%. Critical support on the downside, 56.50, 56.35, that is that transition zone, followed by 5,600, 55.75, 55.65 zone, and then a more significant support zone at 55.20, 5,500. There's two gaps on the downside, 55.69 to 55.97, 56.04 to 56.42. As far as the upside goes, 5,700 was the call wall on Friday that it constitutes the upper bound. This is a major level. Also, the previous session's high. A break would imply continuation of this trend with resistance at 57.20, 57.50, 5770 SPY call wall equivalent, followed by the SPX call wall at 5800. In regards to determining strike selection for 0DTE, we utilize our 0DTE volume feed within our Discord in tandem with our gamma levels to determine directional indication, view on volatility, potential targets, upper bound, lower bound. And we're really focused on two metrics: max call, which is the strike with the highest 0DTE call volume. You can see it visually on the chart here. And the max put, defined by the strike with the highest 0DTE put volume, also visible on the chart. And essentially, we're utilizing these as targets, and we're selling credit spreads at so a call credit spread at or above the max call, and a put credit spread at or below the max put for an element of safety and high probability. You can also utilize the max call for covered call strategies. For example, I'm long equity, the SPY ETF, and over the past few weeks, I was selling call credit spreads at that max call to generate some additional yields. I think I took a total of 8 trades, 8 winners. And doing this is going to collect a lot more premium than just selling covered calls, 1 week, 2 weeks, 4 weeks out. Now, in the event you do breach your short strike, you close above, you can always roll it out to that desired expiration. But implementing this allows you to generate a lot more yield. In terms of volatility, we have seen contraction, VIX down, SPX up, inverse correlation, that is normal, although VIX has remained somewhat sticky, trading between 22.5 and the 20 handle for much of last week. Resistance on the upside shows at 27.28, followed by 30, 32, 35. On the downside, 20 is the big support level. So if we look at the open interest for the upcoming May 20th expiration, we can see the high concentration of open interest at that 20 handle for both calls and puts, making it a potential lower bound and max pain going into that OPEX. As far as the upside, we see call activity at 25, 30, 35. 35 is that highest call volume strike, or sorry, call open interest strike. So potential upper bound into OpEx. So if we look at just sort of option positioning here, we could say that maybe there's more upside than downside in volatility. However, there needs to be a reason to bid vol and sustain vol. Now, VIX is up 8% here pre-market on Monday. This is likely due to puts being pretty inexpensive here, relatively speaking, and traders are going to want protection going into the FOMC meeting. So we want to pay very close attention to the VIX this week, as well as that transition zone. Transition zone is generally an indication for volatility, right? So flip is short for volatility flip. Above, participants tend to favor short volatility. They increase exposure. Below the flip, they tend to favor long volatility, shy away from short volatility, and reduce exposure. So again, transition zone here that is in play this week. Now, if you want to learn how to take these insights and turn them into tradable actions and learn our idea generation process, you can join the team at 0DTEtraders.com. Best of luck out there this week.